So in this research, we look into how this active engagement of private equity investors differ for angels and VCs. Angels invest their own capital, whereas VCs, they create a fund, they manage the fund, and they invest somebody else's money. So when they're investing on behalf of someone else, they need to be more accountable to it. So that's why VC's investment structure is more structured. The contracts are more stringent, and they have a fixed timeline of 5 to 7 years where they have to invest and take the returns out. Whereas angels are more flexible because they're investing their own money. They are more flexible in terms of the timeline. They're more flexible in terms of the contract structures that they design with the entrepreneur. So because of these differences, there may be an impact on how they influence the innovation or performance of a startup. We found that both angels and VC-backed ventures have an equivalent impact in terms of the innovation rate. However, when we look deeper and investigate the impact of the innovation or the success through commercialization through IPOs and acquisitions, we find that VCs have a stronger impact or a stronger influence compared to angels. Now, entrepreneurs increasingly have a choice on whom should they get the investment from. And this is an important aspect from a managerial standpoint to understand whom should you partner with, because the cost an entrepreneur incurs by taking investments from private equity investors is huge. So one should know what kind of value they bring on the table before partnering with a private equity investor. And it also has implications for policymakers as well, because policymakers generally traditionally focus more on VCs, and angels are kind of neglected in that aspect because there's not much information about them. So this study also illustrates how angels can contribute equally towards the development of towards the entrepreneurial development of the economy.